The Finance Act 2019 for real estate investment trusts, which you normally call the REITs. The REITs are special purpose vehicles that serve as holding entities for investors' interest in large commercial or residential real estate projects. REITs may take the form of companies or trusts in many jurisdictions. In Nigeria, however, the Securities and Exchange Commission regulates trust REITs and the unit trusts of each REIT and corporate, as well as corporate equity REITs. So SEC has this responsibility, and what we are doing in the provisions we made in the Finance Act is to be able to expand the opportunities in the market. However, as trusts do not have independent corporate personality, trust REITs cannot leverage their landed assets to raise a significant amount of debt capital required for most large-scale real estate developments. Unit trusts REITs are hybrid REITs that benefit from some tax incentives under the Companies Income Tax Act, but are generally not as attractive as equity REITs that are incorporated as companies, as the SEC limits the amount of the capital that incorporated REITs can raise to protect investors. The corporate or equity REITs are the optimal form of REITs in most jurisdictions. As a project vehicle, the SPV, holding the title to the landed property, are ring-fenced from each other to protect them from insolvency events or defects in land titles. The immediate SPVs holding the project vehicles themselves are held by a holding company or parent SPV, which issues shares and other securities to investors, usually through a stock exchange like the Nigerian Stock Exchange. Prior to the Finance Act of 2019, the intermediate SPVs and ultimately to the holding company or parent SPV, the FRS could apply an excess dividend tax in each of those levels. And due to this rule, it was challenging to redistribute the dividends at each and every corporate level to companies to also be able to tax company income tax. So while corporate tax or equity REITs are the most optimal type of REITs for raising capital or ring-fencing projects from insolvency events of defective land titles, the multiple corporate taxation was the major disincentive to using this type of corporate structure for the REITs. Market research indicates that there are only a handful of successfully completed REITs listings in the Nigerian Stock Exchange today. And some of them are the Sky Shelter REITs, the Union Home Hybrid Unit Trust, as well as the UPDC REITs. Given the need to accelerate reforms to attract capital available to real estate investments across the continent, we have worked closely with the Securities and Exchange Commission, as well as with industry, and with the Capital Market Master Plan Implementation Committee, CAMEC, for several years to reform our tax laws. As a result of this, the Finance Act 2019 now eliminates this multiple taxation. Firstly, by eliminating this multiple taxation, at the bottom, when the rents are paid by tenants to the project vehicle or the intermediary holding company, and secondly, at the top. So this is now limited to tax only at the bottom and then at the top. So all the intermediate steps are now not going to be taxed. We hope by doing this that REITs will become more attractive for investors to invest in the Nigerian capital market. The Finance Act 2019 also eliminates the multiple corporate taxation under the excess dividend tax rule, but only for approved REITs duly regulated by SEC. As your financial advisors and tax consultants will undoubtedly have reviewed the Finance Act, and unbundle the technical details of the reforms that is provided in the Act, we expect to see a significant increase in REITs listings in the Nigerian Stock Exchange, a higher level of flows of debt and equity capital being deployed in large-scale commercial transactions, as well as in residential and other real estate projects nationwide. We expect to see the attendant multiplier effect of job creation, wealth aggregation, as well as deepening the capital markets and increase socio-economic development. As you consider your prospects for investments in REITs, and also as you consider multi-billion naira real estate projects under the new tax laws, we will be providing further information through stakeholder implementation workshops that will hold across the 6 political zones of the country over the next few weeks and months. Let me also touch on another aspect of the Finance Act 2019 that provides incentives for regulated securities lending. The Finance Act also provides targeted tax incentives for SEC-regulated securities lending transactions, which are often called stock loans. A stock loan occurs when a long-term holder, for example, a pension fund, or other institutional investors of a share, creates a secondary income stream for itself by lending its own shares for a short period to brokers who are building portfolios for shares for their clients. As shares are fungible, the clients can return an equivalent share of the same company through its broker to the lender at the end of the stock term. To guarantee that the shares will be returned at the end of the stock term, pension funds and long-term institutional investors require brokers and their clients to put up cash collateral that is equivalent to the value of the share units that have been lent. At the end of the stock loan, the brokers return the lent shares from its clients to the pension fund or the long-term investor, and also the lender returns the cash collateral to the client through its broker. From an economic point of view, the risk-averse pension funds or long-term institutional investors earn securities lending fees from renting of its shares for the duration of the stock loan. Risk-seeking client is able to fulfill an order book for that particular type of share to be exposed to the security underlying capital appreciation, and the broker earns its fees from facilitating the stock loan. At the end of the stock loan, which normally lasts less than a year, the pension fund or the long-term institutional investor gets its shares back together with the security lending fees that it has earned. The client obtains its cash collateral back, net of the mark-to-market adjustments that arises or falls in the value of the share that was lent, and the broker earns their brokerage fees. Through the secondary and tertiary trading markets, the stock loan facilitates stock exchanges across the world, and it has helped to deepen a lot of exchanges in trading volumes. By this kind of trading, there is leverage passage holdings of the shares of these long-term investors, and it also catalyzes the capital markets. For instance, I understand that the Johannesburg Stock Exchange was able to use securities lending, derivatives trading, and capital market reforms to grow from share trading volumes of 2,500 trades per day in the year 2000 to 700,000 per day in recent times. This is to say that the opportunity is really immense, and I do hope the Nigerian capital market will take full advantage of it. To protect parties such as the clients and the pension funds and the long-term institutional investors from the insolvency of their market counterparties, or even the intermediary brokers, each stock loan is treated in law as an outright sale of a share, with the legal obligation to repurchase an equivalent share at the end of the stock loan. As our tax laws generally follow the legal form of stock loan, there would normally be tax liabilities arising from each step in the transaction, even though this is economically not a sale of a share, but rather a stock loan that is structured as an outright sale, with legal obligations to repurchase the share at the end of the transaction. The Finance Act 2019 simply allows the FIRS to ignore the tax liabilities arising from the intermediate steps of the stock loan and only tax the tax counterparty's income at the end of the stock loan, or the counterparty's gains or losses in the event of insolvency of any of the counterparties during the stock loan period. Now that our tax laws are consistent with SEC's regulations for securities lending transactions, we expect to see increased growth in secondary and tertiary trading in the shares of the Nigerian Stock Exchange. Your brokers and tax advisors may provide you with further technical details and advice when planning your prospective securities lending transactions. We will also provide greater information, more analysis, and technical support on these issues during the forthcoming stakeholder implementation workshops, which we have designed to start happening in the next couple of weeks. I have a few thoughts that I want to share with this meeting. I have highlighted a few of the targeted tax incentives in the Finance Act of 2019 for the Nigerian capital market. And as you may clearly discern, the tax incentive for SEC-regulated REITs only provide benefits after the investors have, 1, built their malls, their hotels, their airports, seaports, or logistics parks, thereby creating jobs and fostering economic development. And that is also after, 2, they have earned and distributed dividends from their rents and profits to investors. Similarly, the counterparties in the SEC-regulated securities lending transaction only obtain the tax exemptions after they have successfully completed their stock loans and repurchases without any insolvency events. Going forward, we are committed to moving away from the blunt and expensive fiscal incentives like import duty waivers, lengthy tax holidays that reward investors merely for an intention to invest. Rather, we will design and implement targeted and more efficient fiscal incentives that reward investors after they have kept their promises to invest, after they have created jobs, after they have deepened our capital market, and also after they have abided by the applicable rules and regulations.